We're here today with a wonderful guest speaker, Faith Henderson from Arch MI. And Faith approached us and said, hey, Glenn, we've got this really cool strategy called the Appraisal Gap Strategy. And she says, do you think this would be a benefit to a bunch of your realtors? And we looked at it and we go, oh my God, this would be fantastic for a lot of our realtors. So we bring this to you today. And I wanted to at least let you know that we here at First Centennial Mortgage have a team. I want to let you know who the team is. I'm the business development manager over at First Centennial. There's our wonderful partner, Tony Marino. He's the branch manager. There's Ben Rosales, who is our loan coordinator, and he's also the marketing assist. And then there's also Tanya Reyes, senior loan officer, who several of you have dealt with also. She's a veteran and just a fantastic service person. We thank her for her service to our wonderful country. We're here today because of combination of things. We have really low interest rates in the marketplace right now. My daughter, for example, just yesterday locked into 2.875 for 30 years. Pretty soon the money's going to be free, but it's under 3%, really low interest rates. And as we all know, the lower the interest rates, the greater, if you want to call it, the more house that someone can then afford. Well, it also brings more people into the pool of potential buyers. When rates are in the 2s and 3s, your pool of potential buyers is much bigger. We also have, at the same time, we've got down payment assistance out there. And in the state of Illinois, we can get up to $10,000. And again, if any of you don't know what that is, please raise your hand or put a question into the chat box, or you can stop us during the presentation and we'll talk more about it. And again, what I would ask of everybody while we're presenting, while Faith is presenting, if there is a question that comes up, you can either do one of two things. You can either just unmute yourself and shout out the question, or what you can do is just go to the chat box and just put a question there. We will open up the chat box and address any of the questions in there at the end of this. So again, we got low interest rates. We've got more buyers being able to be pre-approved because of low interest rates and because of down payment assistance. Those people that have been renters and said, oh, I don't think I can ever buy, all of a sudden, they only have to come up with 1% of the purchase price with these down payment assistance programs, and they can buy up to a home of $336,000. Well, my first house wasn't $336,000. So as long as these people are buying homes under $336,000, they can get $10,000 in down payment assistance from the state of Illinois for their down payment, for their closing costs. And again, just puts more people into the pool. Well, when you have more people in the pool, what happens? Well, when inventory comes to the market, all of a sudden people start to bid up. You're getting 1, 2, 3, 6 different offers, and they get to be above the list price. And then all of a sudden, when people, I've heard, we've all heard crazy stories. I had one story where someone paid $100,000 over the list price. Just crazy stuff out there. But when they're paying over list, it doesn't necessarily mean that the appraisal is going to come in at that higher price that they've agreed to pay. They really want this house. They love the school district. They love the travel routes. So here's people who are willing to pay more than the list price. Well, the appraisers go out and then they come in at a lower price. And what is the basics of lending? We give somebody 95% of the lower of, we give them 90%, we give them 85%, we give them 80% of the lower of purchase price or appraised value. If the appraised value is lower, then that's what they're going to receive as an approval. So what we have seen out there is that we're getting people to look at homes at, say a $380,000 purchase price. We're seeing them, that they're bidding or they're offering $420,000. Well, then all of a sudden, the appraisal comes in not at $420, but at $380, and there's a gap of about $40,000. Well, what do we do as realtors? What do we do as loan officers? Well, the first logical thing is, oh my God, my buyer's going to have to come up with another $40,000 and bring it to closing. And lo and behold, they don't have it. Or they go, okay, we're going back to the table, renegotiating buyer and seller. Not the most pleasant thing. So here we are today with the appraisal gap strategy. I'm going to turn this now over to Faith Henderson, who's going to walk us through what I consider to be a great strategy that's going to help more people, more realtors and loan officers at First Centennial come together to help people when the appraisal doesn't match up to the purchase price. So without further ado, I'm going to introduce Faith Henderson with Arch MI. Faith, take it away.
Hey, everybody. Glenn, can you hear me okay? I want to make sure before I start.
I can hear you just great. And if you want to share your screen with us, that would be fabulous.
All right, we are going to get, I feel like I'm becoming a pro at this.
You are, and thank you for that.
All right, I'm just going to pull up the chat box so I can kind of keep my eye on that as we go. Feel free to ask questions at any point in time, whether you want to throw it in the chat box or you want to unmute yourself and ask. I love questions. They keep the conversation going, and it's amazing the things that somebody else might be thinking that isn't asking it. So make sure you ask. All right. So Glenn, thank you guys so much for having me here today. I am with Arch MI, PMI, Private Mortgage Insurance. So what we do is we insure your conventional loans over 80% LTV. Only conventional, not government. I get asked that question all the time. Government loans have their own insurance. We only insure conventional loans over 80. So how can I be of service and help to you guys right now in this market that we're all experiencing, right? I know where I live right now, there are barely any homes coming on the market. And my friend down the street from me just listed her house about a month ago, right? And when she listed it, she had about 14 offers on it and sold it well over what they originally listed it for. Made me want to go and sell my house. Too bad we bought it last year. But anyways, so how can I help you guys in the event that the appraisal comes in low? Well, let's get started here. Go switch. Okay. So let me ask you guys. We're going to give you a little scenario here. Feel free to put your answer in the chat box, okay? All right, so we're going to use the example that Glenn already used for you. And what we're going to say is your borrower went in on a house that, let's say, was listed originally for $380, okay? They got into a bidding war just like everybody else, and they agreed on a purchase price of $420,000, like you see here, okay? Well, unfortunately, the appraisal comes in and what the house was originally listed at of $380,000. How much extra cash out of pocket do you believe your buyers are going to need to bring to closing in order to make this deal work? You guys can put it in the chat box. And if you don't want to, don't feel like you have to. I'd love to see your answer. All right. So everybody seems to always jump to $40,000. Right. It is $40,000 if your borrower wants to maintain putting 20% down, okay? The strategy we're going to go over here is for borrowers that are looking to put 20% down. The strategy works as well for borrowers that are looking for 10%, but it works the best with 20% down borrowers, because what we're doing is we're playing with the loan to value, which I will show you guys in the math that we're about to do. What does Arch consider appraisal gap reference? Again, it goes back to my first example for you of a purchase price of $420 that comes in at $380, and it's that missing amount of $40,000. That is what we're going to try to bridge the gap for you here, okay? All right. So most people, when I talk to them, they assume that MI is a monthly product, that you have to pay MI every month for the rest of your loan. Okay, some people understand that they can drop MI when the loan gets down to 80% LTV, and then it automatically falls off at 78%. But again, 80% of MI that's done is monthly MI premium. So most people out there don't even know that there are other options to utilize in the MI world. What I'm going to show you here, you guys, is an example of using single premium MI. It's a one-time MI premium payment up front. So what you guys see here in this first category, okay? My first example, purchase price, we're going to go back to what we've been using, easy math for me, of $420,000, okay? Borrower agrees, they love it. Appraisal comes in at $420,000. Fantastic, perfect, no issues, we're all happy. They wanted to put 20% down. They have a loan amount of $336,000, down payment $84,000, estimated closing costs, interest rate 3.25, term 360 months, so 30 years, and their overall payment is $2,022. Perfect loan, okay, everything's there. 20% down, low interest rate, monthly payment of $2,022. What I'm going to show you next, unfortunately for your buyer, it came in $20,000 shy, okay? The appraised value came in at $400,000 versus the agreed purchase price of $20,000. So now your buyer's sitting there, they're thinking, wow, I got to come up with $20,000 extra in order to buy this house. $20,000 is a lot of money, and some people don't have $20,000 sitting around. And in their head, because their mom and dad probably told them that you have to put 20% down to buy a home, they're not thinking that they have any other options but 20% down. Well, in this case, we're going to look at single premium MI. Again, let me emphasize, this is a one-time upfront premium of MI. In this case, in this scenario, it will cost your borrower $1,377 in MI, okay, to bridge the gap between the appraisal gap here. So what happens is the appraised value came in at $400,000. Glenn told you that we have to go off the lesser of the two. So we're going to base our LTV off of the 400, which puts us at 84,000. The loan amount stays the same as the first scenario, okay? But the LTV goes to 84, which makes them have to have mortgage insurance, which again, is only $1,377, okay? Their rate will stay the same, their term will stay the same, and their overall monthly payment will stay the same. So instead of bringing $20,000 extra, okay, because it came in $20,000 less, they're bringing in $1,377 extra. Okay, that's it, and their loan terms are staying the same.
Hey, Faith.
Yeah.
Faith, this is Glenn. So if they pay for that MI up front, the $1,377.60, that means that they will not have in their monthly housing payment any monthly MI. I want to make sure the realtors understand that if you pay for single premium up front, you do not have it then in your monthly payment. So they're not going to have an additional $100 to $200 per month in their monthly mortgage payment. Is that correct?
Correct. It is a one-time upfront MI premium. And now they don't have to bring that extra 20 grand. They just have to bring that one-time payment, and they never see it again in their mortgage payment.
That's fantastic.
So my next example, worst case, we all hope this doesn't happen, but it's the $40,000 left, right? So our appraisal here came in at $380,000, all right? Wow, now your buyers are really going, okay, how am I gonna get this house? I'm in love with it. It's everything I want, but now I gotta come up with $40,000 extra. Well, just a little thing about MI so you understand. MI is kind of like a loan in a way for how we price. So your rate for a loan is tied to certain risks, right? Loan to value, credit scores, debt, things like that. And so is mortgage insurance. So in this case, because it came in 40 grand less, we're going to base the loan to value off the 380, which puts us at an 88% LTV. Okay, So with that, as an 88% LTV, the one-time MI payment does go up, right? But remember, you also are bridging the gap between $40,000. So that one-time upfront MI premium goes to $2,500. However, I think your borrowers are going to be happy with bringing $2,500 to closing versus $40,000 to closing to bridge that gap and still get their dream home, right? So again, it's all a play on LTV. We're going to roll it in. We're going to go to an LTV of 88%, which requires MI one time, not for their next every month for the rest of their loan, one time of $2,500. And that makes the term or the interest rates stay the same, the terms stay the same, and the monthly payments stay the same. The only difference is your borrower is bringing in a payment for one time for MI. I do see a question. It says, is the MI tax deductible in first year? Yes, it is actually. MI is tax deductible. I will tell you this much, that MI tax deductibility though is a government reoccurring thing. So they did renew it for this year that MI can be tax deductible. That does not mean that come next year, the government will agree for MI to be tax deductible. That is a new feature about 3 years ago that they started allowing MI to be tax deductible. So for this year, yes, it is. It'll be up to the government if they allow us to be tax deductible again next year. So are there any questions on single premium one-time upfront payment?
Yes.
How that works, why that's bridging the gap? Yeah, how can I help you?
From what I'm understanding by the way you just explained it, it looks to me as if, let's say the worst case scenario, the $40,000 the buyer is getting for free. It can't be right.
Well, that would be great, right? So it's, you know, it goes back to the reason the strategy is working for a 20% down borrower, right? So what we're doing is we're upping the LTV. Your borrower was originally, if you see where my mouse is, thinking they were going to have an 80% loan to value, okay? But because the appraisal came in low, we have to base that loan to value off of the appraised value. So 380,000, right? And a 336,000 of the 380 appraised value is 88% LTV. So they're financing the same amount of money as before. The money's, it's not technically free. It's just we're rolling it into the loan to value, and then that makes it an insured product, right? So it has to have MI. Does that make sense? Glenn, maybe you can kind of help me break it down.
Yeah, Yvonne, I mean, the difference between, if you look at all three examples, the purchase price hasn't changed, $420, and the loan amount hasn't changed, $336. The difference between those two numbers is $84,000, which that line about 5 lines down says down payment. So they already know they're coming up with $84,000. It's a matter of that loan amount of $336,000 is not changing. So the mortgage insurance is kicking in. You're no longer doing an 80% loan. It's not like the $40,000 is a gift or anything. They already are coming up with between $420 and $336,000. They're coming up with $84,000. The lender, through the MI company, is willing to make the loan, approve the loan, not at 80%, but at 88%, because they're taking out mortgage insurance, which mortgage insurance insures, think of it as, it's not exactly this, but the top 20% of the loan amount. So because any lender will make a loan at 80% loan to value, right? There's no mortgage insurance required. As soon as you go over 80%, the lenders all go, well, wait a minute. I want mortgage insurance to protect me in the event if there's a default. So mortgage insurance is insurance in the event there's any type of insurance is available out there, whether it's a car, whether it's mortgage insurance, in the event there's an accident. An accident in the mortgage world is they stop making a payment. So you've got your loan to value has gone up, Yvonne, to 88%. They're still putting down $84,000 to bring such that the loan is at 336,000, but the loan amount now as a percent of the appraised value is at 88%. The lender says, hey, I'll make an 88% loan. You just got to have MI, and they've elected to do a single premium, $2,500. And so now all of a sudden, so now you only bring another $2,500 to the closing, and theoretically, if you guys can focus on that as realtors on that MI line, that's the discussion. You go back to the sellers and say, hey, it didn't appraise out. Make them think that it's a $40,000 gap. Oh my God. And what you do is you ask them for a seller credit for $2,500 so that your client, the buyer, can then pay for the $2,500 that's going to be on the settlement statement at closing to pay for the MI. Correct, Faith? Isn't that what, one of the strategies would be for them to go back to the seller and ask for a seller credit, not for $40,000, but for $2,500 to pay for the MI premium?
100%. So that was kind of part of my spiel is, you do have wiggle room with your seller now because, it's a $40,000, gap, and your borrowers are still willing to buy that house, right? Even though it appraised for under $40,000, and all they're asking is for the borrower or the seller to give them a one-time upfront single premium of $2,551 for credit. So that's covered. So your borrower then technically isn't even paying for the MI on the loan. The seller is.
Gotcha. Okay, I get it now.
I mean, doesn't it seem like a fabulous strategy? I mean, to be able to go back and not think that you have to negotiate a difference of 40,000. All you're doing is asking them for either the buyer to come up with $2,500 or go back to the seller and ask for a credit for $2,500.
Right, and that does. But to me, the buyers, now they have negative equity.
So,
well,
they have less equity in the house.
Well, I think they kind of knew that going in, that if it was listed at 380 and they got into a bidding war, there's a lot of them who are overpaying that they have negative equity day one.
Mm-hmm. Yeah.
I mean, that's not a surprise. That shouldn't be a surprise to any of them when they're bidding $40,000 over list price. Hey, I might have negative equity. Yep, you might have negative equity, but they love the house. They've lost out on probably 4 or 5 other offers that they've made. Somebody else has outbid them, and they're going, no, we're not going to miss out on this one. We're going 40,000. So, right. And you notice the monthly payment hasn't changed on the bottom of the screen, which is kind of cool. Their monthly payment still remains the same, and their interest rate remains the same, because in the lender's eyes, it's not an additional risk because you've got private mortgage. There was somebody else who had their hand up. Was it?
Yeah, it's me. That's me, Glenn. Kevin, can you hear me?
Kevin, we can hear you loud and clear. Go right ahead.
Yeah, just want to make sure that I'm clear, because I'm a realtor and an attorney, and I tell you, no attorneys know about this. So
we need to do this with the attorneys then.
You really do. Let me just make sure that I'm clear. So the insurance company is on the hook for whatever portion of the 20% is as a result of this new deal configuration, correct, Faith?
Well, let me answer it this way. I'll let Faith answer it too. The loan amount is $336,000, Kevin, right?
Yeah.
The lender has agreed to make a loan at $336,000, provided they get enough of insurance to bring the loan back down to 80% or less loan to value from a risk point of view. So if there is a default, no mortgage payments are being made, the lender is going to pull the insurance policy out of the drawer, and it's going to hand it over to Faith Henderson at Arch and say, I'm filing a claim. I have a damage. Right. I'm not getting paid. They're not going to pay off the loan. They're going to pay down the loan to where now loan to value is no longer 88%, but it's going to be something like 80% or less. And then they're going to then the lender is going to turn to their attorney, Kevin, and they're going to say, now begin foreclosure proceedings, because typically through foreclosure, we lose the top 20% through 9 to 12 months, to do the foreclosure. We're not getting payments, loss of interest. Right. We got to remarket it. We got to list it with a realtor. We got to repaint, and we got to refresh the house. So they knew that, they're going to lose in the top 20. But if they get their risk down to under 80%, lender says, I'm all good on that, and I will file a claim should there be a damage where I'm not getting mortgage payments, and it'll bring it down to under 80%. Faith, you want to add anything to that?
Yeah.
Yeah, I mean, I'm just gonna, so the borrower is always gonna be liable for the entire 336, right? I mean, that is what they're signing. They're saying, this is my loan amount, I owe this, I'm gonna pay it back.
Yep.
But what I'm doing is I'm insuring that percent that's over 80%, right? And I'm
Yep.
insuring that for, we'll use for Centennial as the example. So in the event that the borrower or the buyer, however you want to look at them, default, right? And they stop making their mortgage payment, First Centennial will come to me and I will give them, right, their claim for the money that I've agreed to insure. So they're taking less risk on the loan because they're going over 80 and they have me on it to pay them back for what the borrower is not paying them.
So in one of your examples, if it was 84% LTV after the single premium strategy, the insurance company would be on the hook for the 4%, and then the lender would get their 80% from the mortgage on the collateral. Is that right?
Yes.
Yeah, pretty. You know, to be honest, if we really wanted to get into it, when 2008 happened, mortgage companies made money off of the MI companies because they sold the house for more than for like a certain amount, like more than what we already covered. So like the way we overlapped, they made money off of the MI.
I'm sure since then you've changed that policy to prevent that from happening. Yes. Yes.
that became when we noticed it. But yeah, it's, you know, but we insure them. So it's, so that's why your borrower, you know, their rate's not changing and stuff is because there's insurance on it. And, you know, I do have a slide further on that I think Glenn can attest to. Mortgage companies like First Centennial, you know, there's investors out there that buy these loans, and those investors, they like MI because again, we're insuring this product, so they know they're going to get money in the event of a default. And typically, even though I do this and I put that this rate stays the same, most loans over 80% price better by about 0.25%.
Absolutely. I mean, it's nice to say in this slide that it's 3.25, but you know, it's something like when we look at it as loan officers and we see 85, 84% loan to value, we see better pricing because in the eyes of the lenders who sell them off to Fannie Mae, in the eyes of the lenders, they're saying this is a better risk loan. We've got the top portion insured. So, I mean, to Kevin's point, to make it easy for everybody to understand, if you see 84% loan to value, that 4% is being insured by Arch MI. When you see the 88%, that 8%, the amount over 80, is being insured by and will be paid by Arch MI should there be a default. And then, just as Kevin said, he says, then the bank has to exercise its rights under the mortgage and get its collateral foreclosed upon, and then get proceeds by listing it with a realtor, selling it, and that's how they'll pay off the remaining 80%.
And Glenn, you were saying, and you too, Faith, that the originators are getting more money on the sale of this origination because it's insured. That top part is insured, so they can get some more juice when you sell it.
Well, your borrower gets a better interest rate.
The borrower gets a better interest rate.
Yeah, the borrower actually, it can price better by 0.25%.
We're not getting anything better in when we sell it off in the secondary.
Okay.
But what the lenders are doing out there that we work with, they're offering a lower interest rate, and it might be as much as 1/8. Like you'll see in a future slide here shortly, Kevin, that you know, for this rate, with the lender would probably be giving a credit toward closing costs. Let's assume that these 3.25 rates, there's no credit, there's no premium here that the lender can give a credit toward closing costs. But when you all of a sudden put MI on it, I'm saying that you can get 1/8 lower in rate, and you might even get a credit for several $100s that the borrower now can use toward closing costs. So MI is looked upon by the lenders as being a less risky loan than if you don't have MI.
And just out of curiosity, Faith, is this profitable for the MI companies? I guess, what percentage of these go bad? I guess a small percentage because they're underwritten well. So you guys are making money doing the deal. Right.
Yeah. So, this, for us, everything's risk. Okay. That's what we are. So we monitor, obviously, the risk is out there every day to decide where we want to price MI. Okay.
Right.
Because we know we're going to pay claims if the loans go bad. Loans under 90% LTV price very well because they're, again, a lower risk because your borrower is still putting down a good amount of money, which makes them a less risky loan.
Yeah.
And we're getting our money up front instead of waiting to get it every month. And let's say something happens in a year and that loan goes bad, we got our money up front.
Right.
We're not out that monthly premium. So yeah, I mean, it's a great product for MI companies.
And are there any situations where a borrower could not get MI on a conventional loan?
Oh, yes, of course. So we do underwrite loans. Is there a chance that a borrower could not qualify? Yeah. Here's what I will say. We follow Fannie and Freddie like First Centennial does. We try to mimic the guidelines of what the loans do as well. We don't have overlays if you have a Fannie Freddie approved loan. We pretty much follow the same guidelines. It's very rare I deny a loan. Have I denied one? I mean, I've been here 3 years. I've probably denied maybe a handful because we disagreed. But a lot of those too were possibly portfolio loans, so special lending loans that had different guidelines. But
Kevin,
it's very rare.
Kevin, think of it this way. If First Centennial Mortgage, if the underwriting department approves the loan through Fannie Mae or Freddie Mac, it is 99.9% going to receive MI approval.
Got it.
Because they use the same guidelines that we do. They look to Fannie Mae's guidelines, and the key word here is guidelines. It's a matter of interpretation. Like Faith says, she's maybe had 6 in the last 3 years, but they were probably special loans. There was a lot of gray matter in the file. But I mean, if your client gets an approval, and again, you got to remember this, typically the lender, First Centennial Mortgage, it's not like the client has to go in 2 different directions, one to First Centennial, then one to Arch. We do it all for them. We underwrite the file and we go get the Arch mortgage insurance approval. And so when we issue, hey, you've been approved, it's going to say in there that we've already received MI approval from Arch.
Got it. Okay. Thank you very much.
Absolutely. Great questions.
The great thing too with our relationship with First Centennial is we operate a little different with certain companies, but with First Centennial, we have a great relationship. They have a great portfolio with us, and we are what they call like a delegated customer with us. So we don't even underwrite their files. We pretty much just issue them the MI certificate without even getting the file to underwrite at this point. And so once that's issued, I mean, we very rarely ever have a file come back to us. Some ones are different where I have to underwrite them for the customer, but with First Centennial, it's really a click of a button for MI for them.
I think the key thing that's important to note, I'm just going to reiterate it, that we're a delegated underwriter for Arch. So when our underwriter approves a loan at say $336,000 and it needs MI, that same underwriter is approving the MI at the same time. So it's one stop shopping, get the loan approved, get the MI, and if there's any other conditions, let the borrowers know, go let them chase a few more documents, and we're moving forward. So yeah, it's one stop shopping, and it's we're the delegated underwriter, and they don't have to deal with 2 different underwriters.
Yep, it's a benefit. I am reading too in the chat, someone asked me, how are they getting to that number of 2,551? Is that a percentage? So that upfront MI cost here and where it comes from, Glenn, so your loan officer, and I always use Glenn as my example, but there's Tanya and there's Tony on the phone and stuff too. So, but your loan officer that you work with, they will provide the MI premium. Okay, so they go on our system And like for First Centennial, I like to use them as an example because they're a really easy customer for mine. I'm actually built into their lending system. So as they're underwriting your loan, they'll hit get MI quote, and all the parameters from the borrower's credit score to their LTV to their DTI will automatically filter through Arch, and that price will automatically filter back to them. It is risk-based. And we use the example here based on this LTV and like somebody with like a 720 credit score. And this is the price that we come up with. But it is risk-based, so this can either get better or it can get, you know, a little worse, depending on the quality of the borrower. But they will provide that number. So it's always good to make sure you explain to your buyer up front, like say, hey, you know, we're in a bidding war here, and we have strategies. If we run into an issue, you know, you got to be aware your appraisal may not come back at what we're going for. So let's just make sure you talk to the, you know, your loan officer, Glenn, right away, and, you know, tell him kind of where we're at, and then he can kind of run some numbers for you and me, and we can kind of know what, you know, what we might be looking at if the appraisal doesn't come in.
And let me just add to that. I mean, risk-based, you know, how do we come with the 2,551? I mean, what loads into coming up with that premium is the less risky someone is, the lower the premium. The more risky someone is, or the file is, the higher the premium. So it goes back to your credit score. Is your credit score 780 or is your credit score 620? Is your debt to income ratio, are you at 49% debt to income ratio? Or are you at 25%? I mean, that's what determines this premium. So it's not like it's a percentage. It's a function of your credit score, your debt to income ratio. Those are going to be important factors. Your loan to value, you know, here we are at 88%. Obviously, you can see that at 88, it goes from $1,377 to $2,551. Well, you know, that's because it went from 84% loan to value to 88. So take into consideration that we as loan officers, Tony Marino, Tanya Reyes, they're going to go to the Arch MI chart, or actually just they're going to take their electronic file, run it through Arch's computer, and they're going to come back and say, well, based on this FICO score, this credit score, this loan to value, this debt to income ratio, this is the premium. And then they're going to communicate it, you know, to you guys, to your client, and you know, you're going to be that much smarter and that much better having an option, plan B, should the appraisal not come in where it's supposed to be.
I'm looking at the chat box to see if I missed anything. Someone does have a question that I don't have the answer to, but maybe somebody else on here does. They said, has anyone experienced a seller that wanted to challenge the appraisal and ask for a second appraisal? Any tips or insight on this situation?
I mean, I can talk a little bit about it. I wouldn't mind if Tony were to unmute himself and also chime in. There's rarely do we get a second appraisal. Rarely do the lenders say, well, let's get a second appraisal. Because they first off, lenders vet and approve their appraisal companies, and the appraisal companies vet and approve their appraisers. And so the first option is to contest the appraisal. There's a form. Should somebody say, oh, they're crazy, you cannot go, when you challenge an appraisal, when you contest an appraisal, you cannot use listings. Oh, they're listing them for 420, for 450, for 460 in the neighborhood. That's not going to win the argument. They only go by what is sold in the neighborhood. So if you as realtors see an appraisal come in here at 380 in this example, but you've got sales, similar square footage, similar number of bedrooms and bathrooms, similar features. If you see something at 400, at 420, at 430, you need to then print those off, the MLS and give them to your client, because on the form it's going to say attach any documentation you might have. And, again, we're dealing with human beings. They're appraisers. Might they miss a good comparable in the neighborhood? Sure, they could. And so if you've got good comps of other homes that have sold in your neighborhood that validates the higher value, by all means, contest it. Tony Marino, Tanya Reyes, they'll be more than happy to send out the form. You basically fill out the form and attach, the better comparables. Those are then sent into the appraisal company, to the appraiser himself, and they agree, or they will rationalize back to you why it is not a good comp. They're not just going to say yes or no, but they'll tell you why they're either a good comp or why they're a bad comp. If it is a good comp, they'll change the value. If it's not, they're going to stick with the value that they have. But rarely do I ever see a second appraisal ever come through. Kevin, you've raised your hand.
Yeah, just a quick question, Glenn. Is your underwriting in-house at First Centennial, or do you have to go to Boca Raton, Florida, or wherever to get the underwriting answers?
That's a great question. I'm down in Florida sometimes. I wish it was there. No, it is, our corporate headquarters is in Aurora, Illinois. And we have a great underwriting team, because several of us have come from the broker network. We're not brokers, we're mortgage bankers. And as mortgage bankers, not only do we originate, we also underwrite, which means that Tony Marino, Tanya Reyes, they have direct access to the underwriter, to the head underwriter.
Excellent.
What I find amazing is that when I get a file where somebody's been bankrupt or somebody's had, I got gray matter in my file, I know I can pick up the phone, I can call the head underwriter, not just any underwriter, the head underwiter, and I can get an answer by the end of the day.
Perfect.
I find that invaluable to me as an originator, to get back to my client as here's the plan of action. This is what we have to do. And I know that when we bring the file in, that we've already documented it with the head underwriter, and it's going to continue to go through underwriting.
Perfect. Thank you, Glenn.
You bet.
I have a question.
Yes,
Can you
sir.
hear me?
Yes, we can.
Hi, I have a question concerning a multiple offer situation. Say you had, 5 multiple offers and they were all within the same range, even like within $5,000. Does the appraiser consider that due to the fact that the buyers feel that the property is worth it, does it give it any weight? Or are they still going back to closed comps and that's the end of it?
They're going back to closed comps. They realize that in today's marketplace, there's an emotional frenzy out there that people want to buy, and they've missed out on 2, 3, 6 attempts to buy. And so even though there's multiple offers, 5 of them, 7 of them out there, they don't look at offers at all. They do look at listings, but again, they don't really use that in their comparable charts. They'll expand them. Typically they'll put the subject property and then 3 comparable properties. And if that's not enough, they will then go to comp 4, 5, and 6. So you might see 6 comparables, but they're all sales. And typically they want them in the last 6 months.
Right. Yeah, I just had someone mention that I think it was out in Park Forest that some appraiser took a look at all of their the offers that were there, first page of offers, and considered it to be what a buyer was willing to pay, which raised the value on the property. And they took it.
Yeah, they may have, again, I can't speak for the appraisal industry. I just know what the appraisal industry is supposed to do.
Mm-hmm.
And if they want it sold to Fannie Mae, you got to remember too, it depends on, we're talking here loans, majority of conventional 30-year, 15-year fixed rates, they get sold to Fannie Mae or to Freddie Mac. If somebody is using what I call a portfolio lender, somebody who's not going to sell off their loan, they're going to keep it in their portfolio. Well, they may accept, or they may allow the appraiser to do something like that. But if you were to try and sell a loan to Fannie Mae and Freddie Mac and they saw comparables were on other offers made, that loan would not get sold to Fannie Mae or Freddie Mac. You better be willing to hold it in your portfolio, because you're not going to be able to sell it off.
I see.
So I'm saying it could happen. It's just that I don't know the facts and circumstances surrounding, your file there, but, for someone to all of a sudden do a spreadsheet of comparables and it doesn't say sold, sold, sold. It says listing, offer, offer, offer. I don't see how that loan is going to get sold effectively to Fannie Mae.
Okay. I understand. Thank you.
You're welcome. Any other questions right now before Faith goes to the next slide? Faith, continue.
All right. All right, so we talked about single premium. It's a great product. And now I'm going to show you single premium MI finance. So let's say you guys get into that issue that we've been talking about, $20,000 less, $40,000 less. You tell Glenn and them run the numbers and they're like, yeah, we can get this done with the single premium. It's the $1,300 or it's the $2,500 or $2,200 dollars. Well, it's your borrower says, well, I don't want to bring anything extra. I have nothing extra to bring to closing. I have everything I'm giving you. And let's say you go back to the seller and you say, okay, it came in this much lower. We're willing to still move forward. Can you give them a seller credit? And your seller is absolutely adamant that, you know what, I don't care what the appraiser said. I know what my house is worth and I know I'm going to put it back on that market and somebody else isn't going to ask me for a credit for $1,300 or for $2,200. Now you're sitting there going, all right, what are we going to do to make up that money so this buyer can still get this home? Well, they have an option to finance the single premium because they have that wiggle room in their loan to value. So when you finance the MI, before me and Glenn had showed you guys, the loan amount stayed the same through the term of the loan. If they decide to finance it, it will go on the top dollar of the loan amount. So in this case, their loan amount will go from $336,000 to $337,377. Okay, so that's adding in this extra MI premium of $1,377. So again, they don't bring 20 grand in. They're going to roll this into the loan amount. The LTV in the first example, I think we were like 84 exactly. Here we're at 84.3 because we rolled it in. Okay, so the LTV went up a little bit. The MI premium is the $1,377. So instead of bringing a one-time fee, it will affect their bottom dollar payment. Okay, so if they finance it, their payment's going to go from $2,022 to $2,028, which does raise their monthly payment $7 overall, right? And because it got added to the top of the loan amount, but it is $7 a month versus them bringing in $20,000. And they didn't want to bring in any extra money, and the seller didn't want to give them any credit. So they're still getting that dream house for only $7 more a month than what they initially were going to pay. And if you look over here at the $40,000 less column, it affects their payment by $11 a month overall, because they're going to finance it in. So the loan amount here goes up again, right? LTV is at 89%. Their cash to close stayed the same, but their overall dollar payment here went up about $11 to bridge the gap of $40,000. Okay. A lot of people, I think, if they have the dream house that they want, they know they got themselves into a bidding war, $11 extra a month to still get that house is worth it to them. So it's single premium MI finance. A little different, same concept, but it affects the bottom dollar on there here. Any questions on that? So $7 increase, $11 increase versus $20,000 extra or $40,000 extra.
Yeah, and what this does, Faith, is this avoids, like you said, seller's not budging, not going to give a credit. They're out of cash. They can't bring any more. Well, we still have a deal on the table. Can you afford, can you afford $6 more a month? Can you afford $10 more a month? Oh yeah. Oh, great. Let's keep moving this thing to closing then. So yeah, that's a beautiful, that's a beautiful way of doing it when, all parties don't want to negotiate or you're out of money, you can still have the deal on the table.
Yep. So Rob has a great question, and Rob, I am going to get the answer to your question based on the next slide. So we talked about single premium, right? Coming up front, the borrower bringing it in, the seller giving you a credit to cover it, so your borrower doesn't cover any. We talked about financing that one-time premium, right? Increasing your monthly by either $7 or $11 a month, not bringing 20 grand, not bringing 40 grand. But let's look at the idea of our typical monthly MI premium, right, that everybody's used to seeing. Monthly MI is able to help bridge the gap as well. It's not a one-time upfront premium. It is, they pay monthly, okay? In this case, we just used the one example where it comes in $20,000 less, all right? So it came in, we're at 84%. We now have a monthly MI premium. So mind you, there are many options for MI. There's monthly, there's single premium finance. These are different products within the MI category that Glenn and Tanya and Tony can all price, okay? So let's say they want to do monthly MI, okay? And in this case, doing the calculation, when they send it to Arch, it comes back and says it's going to cost the borrower $40 a month in MI, okay? So the premium's going to go up, or their overall payment's going to go up by $40 a month, right? Well, Rob asked a question for finance MI, and he says that $11 a month, is that until the LTV goes to 80% or under? So here's why I'm showing you both options on financing single premium and monthly. If you finance the single premium and they pay the $7 more a month or the $11, they will pay that for the life of the loan, okay? That premium will, that extra dollar amount there, it's part of the loan amount now, okay? So that is there forever. But if they choose to go the route of monthly MI of $40, okay, and we're at an 84 LTV, when this loan amount gets down to 80% LTV, the buyer can initiate to the investor on the loan to drop the mortgage insurance, okay, and no longer pay the $40 a month after that, after the loan reaches 80. That is not an option on single premium MI finance. So it might be an overall lesser monthly hit if they finance it, whether it's $7 or $11, depending on if you're bridging 20 or if you're bridging 40, okay? But this, even though it's $40 versus $7, it does have the ability to fall off when the original loan amount hits 80%. So you don't have to pay it anymore ever again once the loan gets to 80%. One other thing that we're showing you here is the ability to have, a possible credit on there, and we'll go over that as well. So the reason we're showing a credit here for you of 840 goes back to the conversation we had a little earlier, that loans over 80% price better. So when we decided to put this loan at 84%, the interest rate, we'll say, came back at 3% versus 3.25. And if they decide to keep the borrower at the 3.25%, they can possibly give them the credit for the remaining amount, okay? Since the loan actually qualifies for a 3% interest rate, but we're gonna give them a 3.2, we'll give them a credit of $840 towards their closing costs, okay?
And we as lenders, we would let them know the choice. We tell them at 84%, you either can get a 3% rate with no points, or you can keep the rate of 3.25, and we now can give you $840 as a credit towards your closing costs. And they can make then, an informed decision. So, and again, to clarify, remember this, on single premium MI, mortgage insurance, there is no MI in the monthly payment. So there is nothing to reduce once you get down to 80% or less loan to value. So let's say it again, single premium MI, you're paying all the premium up front. There is nothing in your monthly mortgage payment. So there's nothing for the lender to lower your payment when you get down to 80%. But when you go with monthly MI, yeah, it's in your monthly mortgage payment that you're paying the lender. So when you go from 84 or 88 down to 80 or less, yeah, petition the lender. You think you got 20% equity, petition the lender and see if it doesn't validate that. Okay.
Sorry, I didn't mean to jump ahead on you. Yeah, so I mean, it's, and cancellation of MI, everyone gets confused. Because MI, monthly MI will automatically drop off the buyer's loan at 78%, but they can cancel it at 80 as long as they remember to initiate it. So keep that in mind. If you have a buyer that, let's say they're like a heavily commissioned buyer, right? I mean, commissioned in their pay, like you know that they work for bonus or commission, and they know that they're going to come into a chunk of money, or they know they're going to sell another house and come into that money, and they're going to pay that loan down to the 80%, and they're going to drop that $40. Well, this might be a better option for them because, well, maybe they're only going to pay the $40 extra a month on their payment for 6 to 8 months, right? And that could be less than the single premium. So when they're going to drop it out at 8, you know, make a large payment on their mortgage and drop it off, it might be a better deal to go monthly. But either way, it's always there to bridge the gap. And I know I keep talking about this as a appraisal gap strategy and bridging the gap. The other thing to keep in mind when you're talking to your seller, and I know this happens to me, I should have seen it coming. I set a price and I said, I'm going to buy a house at this amount of money. I don't want to go over this. This is my purchase price as much as we're spending on a house. I couldn't find a house for that much money. And and in your head, your buyers might be saying, well, I have to put 20% down. I already know my payment's going to be yada, yada, yada. I can't go above this. And what do you know? They're like, hey, I saw this house. I'm so upset. I really want it. It's $450 and I only wanted to go to $400 because here's my monthly payment and this and that. Well, if they're adamant about putting 20% down, they may not be aware of what MI really is. I mean, $40 extra a month to have their dream home, right? Take away the whole appraisal gap, just take away an actual deal at list price of a different home that they weren't even going to consider, right? Because they think that MI is going to be $200-300 more a month on their payment because that's the concept that's out there. They don't realize that they have wiggle room in their purchase to start with altogether, and that their interest rate may be better. So just keep that in mind to them. Say, hey, you really got to talk to Glenn or Tanya or Tony and just see what if we don't put 20% down? What if we do that, $450,000 house? Just check it out, see what happens, keep everything the same. They may be surprised that they can get that house that they love and want that may cost a little bit more than they originally planned to look at.
Kevin had raised his hand.
Oh.
Kevin, do you have a question?
Yeah, can you hear me?
Sure can.
Mm-hmm.
Yeah, for both you and Faith, my lawyer pea-sized mind is still trying to find that $40,000 on the $420,000 purchase price and the $380 value. I'm trying to figure out how the seller still gets their full $420 when the appraised value was $380 and the loan amount is going to be $336. What am I missing?
Okay. What's the difference? Let's think of it this way. The seller wants 420,000, right?
Yep.
So, and our loan amount's not changing. It's 336. The difference between those two numbers is $84,000, correct?
Yep.
So let's just add those two numbers together. The customer's coming up with 84,000 in cash and the loan's 336. You add those two together, the seller's still getting 420. It's a matter of, is the lender willing to give him the $336,000 without MI? So let's just make it real easy. Just add the loan and add the down payment. They're not changing. And the seller is still getting their $420,000. So the seller's going, I'm fine. You guys are giving me $420,000 at closing. I'm cool. But what the buyer's doing, he's going, hey, the lender's telling me if I don't want MI, they're going to give me only 80% of that $380,000. They're going to lower my loan amount.
Got it.
And you're going, no, I don't want to lower my loan amount. I want it at 336. We go, no problem. Pay for MI, do single premium finance, do monthly, do one of those. And oh, by the way, it's going to cost you, and by the way, you can get a credit from the seller to pay for that. You may not get it, but there's a way that your MI is going to get paid for either all at once, or it's going to be in a monthly amount, and your monthly payment is not going to knock you out of the box.
Got it. Yeah. So this is to induce the lender to give a loan that's more than the appraised, or a higher percentage than the appraised value came back. Got it. Okay.
That's correct, Kevin, because they're willing to do any loan at 80.
Right.
It's now without MI.
Got it.
All lenders across the board, including First Centennial. But First Centennial and the rest of the world is saying, hey guys, if you want 84%, you don't want to change the loan amount. I get it. You don't want to change it. Leave it there. You just got to give us MI in the event that there's a default, so then I can bring ourselves back down to 80% or less. Going back to your point, who's paying that 4%? It's Faith Henderson and Arch MI, so that we're back to where we would have done it with no MI.
Is there a maximum limit on how much gap you can use MI to cover?
So, that's a great question. So, we insure loans up to 97%.
I was about to say, yeah, you could create almost 100% loan with a conventional situation if it was allowed, I guess.
Yeah,
we'll go up to 97.
So it goes back to Kevin. Fannie Mae and Freddie Mac do loans all the way up to 90. They do 97% loan to value if the customer qualifies. There's like certain geographic areas where they'll say we'll do 97%. They do always 95%. They always do 90. They do 85. They do 80. So in the higher LTVs, it's higher risk. Your MI insurance is going to be higher, but there's always if Fannie Mae or Freddie Mac has a program where we can underwrite the file at 95, 97%, Arch MI has a mortgage insurance program to overlay it to bring our risk down to 80% or less.
Got it. Thank you. That makes sense now. Thank you both very much.
You betcha. We love your questions. Your questions are great, Kevin.
Thank you.
The good news to that is that, I'm not a real estate agent, but I do know that I've seen where there's deals where they say, oh, we won't take FHA or, VA buyers at this point. We only want conventional, right? Well, this is still a conventional loan. That's all we're insuring is conventional. It's not FHA. It's not government. You have high wiggle room on a conventional loan, and the buyer or the seller will only see it's a conventional loan. You're getting a conventional loan. We're just insuring it. That's all.
That's pretty slick. So you can mimic an FHA loan on a conventional deal, theoretically.
For LTV.
For LTV.
Loan to value.
And Kevin, do one better. Do one better, Kevin. On FHA, once your loan to value goes down to 80%, because we do a lot of them at 96.5%. Okay, that's the typical. Right. You need at least minimum of 3.5% down. You can finance 96.5. So now over the years, all of a sudden, your loan to value goes down to say 75%. You cannot drop the MI on an FHA loan.
Oh.
You must refinance, and hopefully the interest rate scenario at that time in the marketplace is in 5, 6, 7, 8%. On a conventional loan, you're getting 3.25%, you're getting 3%. And when you get down to 20% equity in the property, you can petition the lender on a conventional loan to just drop the MI portion, still keep the low rate. The rate doesn't change. The rest of your loan doesn't change. You've just dropped the MI and you go, woohoo, this is great. I keep the low rate. So all the people that are closing on loans right now who have MI, they're all sitting there going, this is fabulous. For the next 30 years, I got a 3% interest rate. And when I get 20% equity, I'm dropping the MI and my payment's going to go down and I still keep the low rate. I don't have to refinance. FHA, you have to refinance.
Got it. That is a big distinction. Thank you very much.
You betcha.
All right. So, we kind of threw this out here. I always put it in here as a little reminder that the interest rate, again, because I don't change it on my slides, but the interest rate, again, over 80% for your buyer on their loan is better typically than at 80. Again, because the mortgage company that's lending the money has insurance on that money for us to pay them back. So the ability for your borrower to either take a better interest rate or to take a credit may be there as well. All right, so, you guys, I'm kind of coming into my slideshow here, just a few notes. It's always great to be proactive with your clients, put them in contact with their loan officer for Centennial right away so they can go over, kind of the options that they have in the event the appraisal comes in low. So especially if you're getting into a bidding war, or you have that buyer that is adamant they're putting 20% down, but seems to not be finding a home in the, space or the price category that they were looking at, maybe telling them up front and being like, hey, you guys, I just saw this thing on MI. It's not what it used to be. It's not an extra $200, $300 on your monthly payment, especially if you were originally looking to put 20% down, your LTV is going to be low, your MI premium is going to be low. So you really should talk to, Glenn, Anya, Tony, whoever there, and see, what room you have and how much more it will cost you if you want that extra house down the street, or, in the event that we run into appraisal issue. Reaching out to the selling agent to discuss the possibility of a seller credit for a low appraisal. This is totally up to you. You guys, how you work it, but, if you've gotten a bidding war and you're just kind of waiting for the deal to come back, you may be wanting to throw it out there to them and say, hey, you know what, we're here, we're going for this, let's talk what happens if the appraisal maybe comes in low. Are we looking at a possibility of seller credit? Or they might make you, I have heard, and you guys are the agents, not me, and I would love to know if this is true. I have heard that there are several contracts being written where you have to purchase it, agree to purchase it for whatever happens with the appraisal, that they aren't going to give you wiggle room up front. So maybe then that's the time to have the conversation about the upfront MI credit, is if you're signing a contract that says you agree to this regardless of appraised value.
That's a great point to make there, Faith. When you think about it, there's contracts out there where they're because of the multiple offers, the sellers are looking for those people that say, hey, even though it doesn't come in at appraised value, you agree to move forward. Because they don't want to really stop the marketing on the home unless you're really, really, really going to buy it, no matter what the appraisal is. For those people, for the realtors that have clients like that or enter into contracts like that, it is really, you need to stop and have a conversation and get a worksheet from Tony or from Tanya as to, what are my options? Just so that your client knows going in that if the appraisal doesn't come in, here is our option. You guys look so great as educators, letting them know that if this doesn't appraise out, we've got a plan B on the table.
Yeah, and from what I see in the comments, it sounds like that is being put into the contract. So it's something to know up front and discuss with them, be like, yeah, we're willing to sign this contract like that. Do you guys have any wiggle room on seller credits for upfront MI? So I think we're going to see more and more of that.
How smart would they look? How great would realtors look? How many more referrals would they get if they were to take that customer who thinks, well, I'm paying $40,000 over. Yeah, I know I'm going to have to sell some of my stocks or bonds or securities in the event that it doesn't appraise out. And then you come back and say, well, it's only like $2,500. And, they're going to go, oh my God, love you to pieces. I got 10 friends that, I need to refer you to.
Well, so you guys, that is all I have. Glenn, I don't know what more you have.
Well, it's not that I have more. I really just want to thank everybody for being here today. I want everybody to know that, it is open for questions. Is there anybody that has still questions that we haven't answered? I'm going to take a look in the chat box. I know we've been looking at it as we've been going along. I want you to know that the team there in Naperville for First Centennial, the branch manager is Tony Marino. His phone number is 804-1059. You can reach him at t.marino@gofcm.com. You can also reach Tanya Reyes at t.reyes@gofcm.com. They'll be more than happy to help you out with these scenarios. They work with Faith all the time. Are there any questions that we can answer while we're all together? Does anybody have questions on down payment assistance? Do you guys realize that you can get up to $10,000 in down payment assistance from the state of Illinois? Client only has to come up with 1% of the purchase price. 640 or better credit score is needed, and they must make less than $109,200. So, I mean, it's most of my clients don't make over $109,200. So, yeah, these, those are great programs. Rates are extremely low. So let me just see. We do have a question. My contact information, here's a question from Kevin, my contact information. I'm semi-retired, so I mean, Tony is the branch manager, but you can always reach me at area code 630-788-7859, or you can reach me at g.marino@gofcm.com. Another question here is, do we do these loans in on houses in Arizona? Do you do them in Arizona?
Yeah, so from an MI standpoint, we lend in all states, or we cover insurance in all states. So
okay. There was a question, is that the down payment assistance, I think question is that for first-time home buyers only? No, it's not. That is a great question. You can be an existing homeowner. I've got people that are coming out of condos in downtown Chicago. They're not getting enough equity out of the property. They're coming out to the suburbs. They're building families. They have 1, 2, 3 children. They're buying homes. They need more money for down payment assistance. So down payment assistance in the state of Illinois is for existing homeowners and first-time home buyers. So it's a plus program. Again, somebody else, what's Tony's information? Tony is t.marino@gofcm.com. Tony can be reached at area code 847-804-1059. Yvonne King wants to know if we're licensed in Arizona. I don't know the answer to that, but I will get back to you, Yvonne. Don't know. Let's see if there's any other questions. Oh, no. Can everybody still hear me?
yeah.
Okay, because I went away for a while. Any programs for 10% down? And again, Tanya Reyes is told, I'm going back to the previous question. Tanya has looked it up. We are licensed in Arizona, so we can refer you over to one of our branch offices in Arizona, and our HMI can do the same appraisal gap strategies out there for you. Any programs for 10% down? Dinar, with respect to 10% down, you can do a conventional loan for 10% down, like we talked about here. Whether it appraises out or not, you can then do the appraisal gap strategy. The down payment assistance program, I would probably look at, if somebody has 10% for 10% down, I would probably show them that it is more beneficial not to use the down payment assistance program. So I would just let them use their own funds, because again, you're going to be paying a slightly higher interest rate with the down payment assistance program than if you just went with your own funds, 10% down, and use the appraisal gap strategy if you needed to.
Christine speaking.
Christine, go right ahead. Christine, we can't hear you.
Oh, I'm sorry. What's the name of the home buyer assistance program?
It's called IDA.
Oh, it is the IDA. Okay, I thought maybe it was called something different. Okay,
It's the IHDA, the Illinois Housing Development Authority.
yeah.
And what the good thing about it is not every lender is certified in the state of Illinois. You got to become certified. And we underwrite the files for IDA. Certain things do go to the servicer, which is US Bank on those files, but for the, it's kind of like we underwrite for Arch. When we do the MI, we underwrite the IDA files at the same time. So it's a one-stop shopping for those loans. We do quite a bit of that.
Yeah, and the IDA loans, don't they, there's so much money that the federal government gives for that. So once it's gone, that's it, right?
Christine, that's a great statement. And I've been around a long time, and that's the gray hair. And in my many years, I'm going to go now back 7 to 10 years ago, where that was the concern. And again, where do we get the funds from? It's a state program. The state sells off revenue bonds to investors. So then they get money, cash, and then they put them into these buckets for $6,000, $7,500, $10,000 programs. Well, I would say probably in the last 5 years, the coffers are so full of, we never have run out of money. We never have run out of money, and because they keep selling off revenue bonds and they keep replenishing it. And there's never been a notice from the state that goes, oh, by the way, if you don't register your loan by November 1st, we're out of money after November 1st. That hasn't happened, but it has happened. Again, you're showing your experience. It has happened many, many years ago, but it is not something. So feel free to, it's an ongoing program. Down payment assistance is there. And here's the big thing. This is the big takeaway for down payment. If somebody can come up with you guys know that rents are going up. If somebody can pay $1,500 in a security deposit and $1,500 in the first month rent, that's $3,000. Okay. If they got $3,000 in the bank, then if they were to look at down payment assistance and be buying, say, a $250,000, $300,000 home, the only requirement on that under the down payment assistance is they come up with 1% of their own funds. Well, what is 1% of 300,000? It's $3,000. So if I got a customer that says I can go rent because I got $3,000 for security deposit and first month's rent, you guys should be talking to them. You know what? You got to talk to Tony and Tanya. They're going to show you that with $10,000, you could be buying a $300,000 home. Now, I'm not saying that they qualify for 300, but whether it's 275, 250, they're only coming up with 1%. So my point is, it might be buying could be less than their first month's rent and security deposit. So please look at that program or ask, Tony or Tanya to show you what I call cash needed at closing using down payment assistance. And you might find that, they shouldn't be a renter. They should be, and any of you who are on this call who are leasing agents, I know you guys get, you get hundreds of dollars for when you do a lease. What do you get if you get 2.5% on a $200,000 home? You get $5,000. I mean, I'd be trying to talk to all my rental customers about, hey, talk to Tony and Tanya. You might be able to buy for the same amount that you'd be putting down for security deposit and first month's rent. So I'll stop beating that to death. And
the IDA is good for condos too, right?
It is good for condos. It's good for townhouses. It's good for single families. I didn't give you Tanya Reyes's phone number, and her phone number is 630-947-0562. Rob Ross says, thank you. Many of your realtors are saying, yep, that's the way it's been in many of the contracts. Tony's info, Arizona. To reach Tony, we got his number there. IDA is funded by the Illinois Housing Development Authority revenue bonds. Oh, and one more thing, it's kind of cool. The IDA program can be used on 1 and 2 unit properties. Now think of this. You get to buy, say it's a $200,000 2 unit. 300,000, but say 200,000 a 2-unit. The requirement of IDA is that you come up with 1% of your own funds. So you're buying it for all of $2,000 because the rest of the down payment and closing costs are coming from IDA. Okay. Now you have and let's say your mortgage payment is $1,700, $1,800. So now all of a sudden you got a tenant for the second unit that's paying you, I don't know, $900, $1,000 a month in rent. So your $1,800 a month mortgage payment minus $1,000. So you're now living in a 2-unit property for $800 a month, and you came up with $2,000 out of your pocket. Kind of cool thing. I've had many a person look at, well, I think I'm gonna look at that 2-unit. I kind of like that. I have some income producing property. I'm in for little to no money, and my mortgage is cut in half. So I just want to let you know more about it.
I have one more question on that, Ida. If I remember right, do you have to hold on to the property for a certain number of years? And if not, I was thinking it was 5. I'm not sure though. And if you sold the property before 5 years, you owed the state money.
The answer to your question is because there's 3 different programs, 6,000, 7,500, and 10. The 6,000 is a grant, okay? And it is a 5-year forgivable grant, okay? So it is, Christine, you do owe it back. So think of it this way. You took the 6,000. State says, hey, stay in it for 5 years. You owe me nothing at the end of 5 years. But let's just say for sake of discussion, there's good reasons. You got pay increase, or you got transferred, or you all of a sudden children are coming and the house is too small. So you got, you say we're going to sell. And so you stayed in it for 3 of the 5 years. Okay, so the state has forgiven $4,000 of the $6,000, right? So when your attorney for the seller, because now you're a seller, so the seller's attorney is going to look on title and say, hey, there's 2 liens. One for the first mortgage. You're going to ask that lender, hey, what's the payoff on what my client still owes on the first mortgage? And they're going to see a lien from the state of Illinois. And they're going to say, hey, state, what does my client owe? And they're going to come back and say he owes $2,000. Okay, those 2 liens will get paid off at the closing through sales proceeds. So
Okay.
it's not like people are coming out of their savings account, but they will take it out of sales proceeds. So they do owe it back if they don't pay it, if they don't stay in for 5 years. Go to the $7,500 one. That's the crazy great program, I call it. You get $7,500. It's 0 interest. So you owe no money while you use it. And there's no monthly payments. So wait a minute. I get $7,500. You're not going to accrue interest on me, and you're not going to bill me monthly? Oh, this is great. And so you live in it for, say, 10 years, 15 years, 20 years. So now, again, you're a seller 10 years down the road. Your attorney then sees 2 liens out there. Hey, first lender, what does my client owe? Okay, we'll pay that off. Hey, what for state of Illinois, what do we owe on that? $7,500. You pay it off at closing. It's like, hey, I got the use of this. It helped me first buy the house because I didn't have $7,500. I got to live in the house for 10, 15, 20 years, and I got to pay you back just what you gave me 10 years ago? Cool. Love it.
Okay.
So does that make sense? It depends on the program. Some you got to stay in for 5 years. Some they don't, you just pay them back whenever you sell the house. And then the $10,000 one is a repayable one. Again, it's a 0 interest loan. So you're not paying any interest on the $10,000, but you will pay $83.33 per month for principal only. So it's a 10-year repay, Christine, on the $10,000 one. So I always ask my clients, if I give you $10,000 today, this would be a good question for you to ask your clients. If I get you through Tony or Tanya, if I get you $10,000, can you afford $83.33 a month to pay it back? All the clients go, yeah, you're going to give me $10,000 and I only got to pay back $83 a month. I'm all in. Let's start looking at houses. So it just depends on the program, Christine.
Thank you.
You betcha. Any other questions? Unmute yourself if you want to. I don't see any more in the chat box. So all I can do is thank everybody for being here. Thank you, Faith Henderson. This was a great, great educational session.